What's up, guys? Eric here. Real talk. I wasn't going to make a video today. Got to get some stuff off my chest. So this is just a real talk, unscripted, unedited. Just going to talk to the camera, talk to you about the stock market and what's going on. So one thing I want to get off my chest right away, I think this is really good. It's not a bad thing. I think it'll help a lot of people. And so I want to get it on YouTube. So we have a private community. We have a private Discord community. It's Patreon Discord. And we've had that for about 2 years. We had a conversation today in one of our elite chat rooms about portfolio building chat. And one of our members, one of our founding members, he posted a great post about managing your spec. So speculative assets, spec stocks. I like to have 5% or less in my portfolio. Sometimes you build 10% if you're younger. The thing about spec stocks is they have the highest risk reward. They can be 10 baggers or they can lose all their value and go to zero. So a lot of those spec names, when you think of some of the stocks in there, like SoFi, any kind of SPAC is a spec. You think of Indy, another SPAC, it's a spec. And a lot of the pot stocks, there's a lot of different stocks that kind of go into that category. And mine's about like 4.7 or 8% of my portfolio is in what I consider speculative stocks. And he posted in there about, a chart showing his portfolio. He's got a separate portfolio for spec, which has pros and cons to it. If you look at it, if it's in your portfolio, you see it all the time. And that opens a whole can of worms too. You shouldn't stare at your portfolio every day, all day. I know a lot of you guys do, and it causes you more pain than it's worth. I only look at my portfolio. I think I've looked at it 8 or 9 times since January 1st. I'm not staring at my portfolio all day, every day. I'm building portfolios. I'm buying stocks I have conviction in, and I'm holding them for long term. I'm not staring at the ups and downs. And I know that there's stocks that you probably have read that stress you out and you're worried about it. So back to my point. So we're in Patreon, we're in Discord, in the Elite. We're talking about managing spec. And there's some good comments in there about, yes, they're the ones that are hit the hardest in this type of environment, but they also have the most reward on the upside. This particular person had Upstart in his spec bucket. You might have it in growth. He had it in spec, which I think is good. It's being conservative. And I look at Upstart. That could be a 10-bagger stock easily, or maybe it gets disrupted or goes to zero. I personally think Upstart should be worth more than $100 a share. I think it should be 150 at these levels, but I posted in the Discord community over the weekend, there are lots of risks to the company in the short to mid-term. And we need to figure out a lot of these things. And the more we hear earnings from different companies, the more we hear about the risks. You think of like the housing market, you think of auto loans, you think all those different things, you start applying it to your individual stocks. Now, if you're holding something like Upstart for 5 or 10 years, you might not be concerned about the 6-month to 18-month short to mid-term story, and you might be accumulating shares. I think between $75 and $95 is a great spot to dollar cost average and accumulate shares on Upstart, but you might not agree. And some people have the mindset of, I'm going to wait till it gets to my price and buy it down there. That's okay too. I like the dollar cost average. But back to the whole spec story, you get the sense from this individual that he's kind of beating himself up. Like, I feel like I could have done a better job dollar cost averaging and, lessons learned. Here's something that I just sent out a message yesterday to all the patrons as well, explaining kind of where the market's at, the potential risks, and just my sentiment overall. And I'm going to share that with you in a few minutes, so stay tuned for that. But in that message, the general message is saying like, hey, these are unprecedented times. I'm going to show you a list of all the different bullet points of the different risks and why we're in unprecedented times. A lot of people want to compare this to 2008 or compare it to .com bubble. They're always trying to compare it to history, but the reality is we're in a situation that's never been experienced before. It's completely unprecedented. I've been in the market, in the stock market, for almost 25 years, and nothing's like this. There's comparisons you can make to other scenarios in different time frames, different sell-offs, but each one is its own, and this one is extremely unique because of the stimulus, because of the COVID pandemic. It's a very unique circumstance. So we're going to go through that, but don't beat yourself up. If you have a position in your portfolio and you believe in it long term, especially if it's in your spec bucket, don't beat yourself up if it's down 50%. Is the company broken or is the stock broken? If the company's broken, you probably want to consider selling it and reposition that capital. If it's just the stock price, well, the company's not broken, I'm still going to hold it. Have I made mistakes and bought some of the companies too early? Yeah, I didn't buy the tops, but I certainly didn't buy the bottoms, and I've dollar cost averaged on a lot of the names, the newer names, and I still have some reds in my portfolio. Now, I have the luxury, I've been investing for a long time. So I've got a lot of stocks like Microsoft since 2013 when it was $30 a share or whatever, and several names like that. I've got a lot of high quality, tier one type technology names. I own things like Costco, Home Depot, United Healthcare, a lot of those for a long time. I've got a balanced portfolio that fits my needs and suitability. And you need to make sure that you build your portfolio to fit your needs, your suitability, and your DNA, like I always talk about. But don't beat yourself up. Yeah, you can learn lessons from it and say, hey, I went a little bit too aggressive on this stock too early. I should have known that this was a risk. I should have known that the market was, euphoric. And if you look at SPACs, I was warning the community for a long time about SPACs. There's just too much money flooding into SPACs. I warned people about Chinese stocks before they went down, and do I have stocks that went down? Absolutely. Most of the stuff that I have that's red, they were the new IPOs. And those IPOs were overpriced. They were hyped. I didn't buy the tops, but I certainly didn't buy the bottoms. You look at like the Unities, the Robloxes, Confluence, there's tons of different names. Snowflake, we've been very disciplined on that one. Buying that stock, 225 or less was always the discipline on that. But other names, not as good a discipline. So you can learn lessons from that. But hear me say this. There's never been a time where so many catalysts were dumped on the market at one time. It didn't give you a chance. And it happened like that. The pandemic, the lows of 2020, look at March 2020 lows, that makes a lot of sense why the market would just do a flash crash. With this, it was like everything looks good. Unemployment, we just saw unemployment at the lowest rates, since the 1960s. We're at 3.6% unemployment, and people are talking about recession. And recession could happen, but you look at unemployment, you look at some of the positive things going on. What we have is we have problems with inflation. I'm going to talk about these problems next. So let me go through. I'm going to show you the actual post in Patreon. This is what the Patreons received yesterday. I also posted this in Discord, and I'm just going to talk through it with you. So the members of Patreon Discord are going to have the luxury of kind of seeing it again and having me give commentary live. If you aren't a patron, consider joining. We have 304 patrons right now, and that gives you access to Discord as well. And we've got a promotion right now. If you guys join the Platinum tier, there's a few seats. You get a 30-minute one-on-one mentoring session with me, and we can talk about stocks, portfolio, whatever. I'm not a financial advisor, but I can give you my opinions, and I can give you information that might help you with your decisions and with your journey. So check that out. So stock market update, here's my thoughts, Real Talk article. And this is the follow-up video for the entire community to make sure I'm staying in front of you guys and helping you through these difficult situations. And if you're new to the channel, subscribe, make sure you hit that bell to get notifications. Definitely join this community. We're over 25,000 subscribers now, growing, trying to get this to 100,000 subscribers. So definitely subscribe, join us. So I want to provide you with an update. Basically I talk about there's several risks to consider, both short-term and midterm, but I do believe it's a good time to accumulate shares if you have a long-term horizon, especially if you're, 2025, 2030 time horizon. I personally am a 2030 time horizon. So I've got about 8 years, and I've got some goals I want to hit by those 8 years. And so everything I'm buying, I'm really thinking 8 years out. And I'm still trying to do my best to get the best prices, but I'm not as concerned with those fluctuations because I'm really thinking really far out. Like, what companies are going to be the next FANG stocks? What are the new 10, the new disruptive stocks that I think can be 5 baggers and 10 baggers over the next, decade? Those are the stocks that I'm focused on, that I'm building up in my portfolio. I've already got a great core of ETFs, of stocks that I've owned for many years, and I'm building around that with some additional growth and kind of that newer technology. So many of the growth names do not have catalysts to take them out of the current range. So basically we're trading in a range where we've kind of hit highs, we've already had a floor, and we're kind of somewhere in the middle. And we've got all these different things we're going to talk about, these negative catalysts. We bounced nicely off the bottom, and I said to the group that we'd find resistance at some point, and it would roll over and come back. I said I didn't think it was going to retest the lows, but it really depends on the catalyst of the market. If you have a lot of negative news, like the Fed was very hawkish over the last few days, predicted to raise rates now by 50 basis points. We're starting to do some quantitative tightening, and that's a little bit more than expected. So that is going to make the market fluctuate. And that's why the market sold off this week. The Fed started getting more hawkish. And that's really what started this whole thing to begin with. You look back of, January of 2022, the Fed getting more hawkish is what started the movement. Then you add all these other issues with supply chain inflation data, Russia, Ukraine, on and on and on. We're going to talk about some of those. So I think opportunities are starting to appear again. For example, the upstarts in that 75 to 95 range, coming back below $100 opportunity. We'll talk about a couple other stocks here. The catalyst for the recent sell-off was comments from the Fed being more hawkish and QT and interest rates. We got Fed minutes yesterday that supported that. So inflation's at 40-year highs. Here's some other risks. Mortgage rates are back over 5%. That's the highest in years, and that's going to cause problems with housing affordability. And so there's lots of arguments on this, like, well, it won't affect the economy, it won't affect the market, this and that. I used to sell real estate, so think about this just from a high level perspective. Okay, if house prices are going higher and higher and higher, if interest rates are low, you can still afford some of these big mortgages. If you do the math, a mortgage payment is now 50% higher than it was not too long ago. And so if my payment goes from $1,000 to $1,500, which is a bad example because most mortgages are much more, but to give you an example, 50% can be significant. You think of a $5,000 mortgage now being like $7,500, or this is a high level example. That now takes some people out of the ability to afford that home. And what it does is it creates less buyers for those sellers. It's a seller's market right now. You can sell it quick, and there's still investors buying homes and things. And that's a whole other story. Rent prices are going to spike because of this as well. There's a shortage of inventory still. So you're like, well, what about builders? Builders are still busy in my neighborhood. Well, those were contracted a year ago or 6 months ago or whatever. And they're building out homes that we're already committed to. Okay, so there's some lag there. You also have to look at just if there's less people that can afford my house as a seller, it's supply and demand. So if I still really need to sell my house, I need to sell it for less to be able to get someone to buy the house, right? I mean, it's just common sense with supply and demand. So that is going to squeeze, and it's going to squeeze the average American because you think of rent prices. If I'm a renter and I don't own a home, I can't afford a house now because the rates are a lot more expensive and the housing prices are all-time highs. So you add higher rates with all-time prices. It's a bad combination, especially for first-time home buyers. So now I'm renting, and my rent just increased in some areas 15, 20%. If I'm living paycheck to paycheck and I'm just out of college and I've got student loan debt and I've got all these other debts and bills to pay, how do I get ahead? And it can be really frustrating. And this is why financial education is so important and why I do YouTube. A lot of people say, I'm just doing this for the money. Guys, I made a lot of money selling software, and I could go back into that anytime, okay? I was making 150K base plus commissions. I'm not making even close to that. My YouTube channel last month made about $700 in ads. I averaged between $500 and $800 a month in ads. That's not very much money for the amount of time I put in videos, especially the production videos where I edit and things like that. I sincerely want to help people. I want to help people be successful, achieve financial independence like I did, because I came from absolutely nothing and nobody was there to teach me this stuff, okay? So anyways, I'll go on a rant. Sorry, but have to get that off my chest. So this is what's going on. So rent rates spiked 10 to 20% in many areas of the U.S., and this squeezes the consumer. They have less disposable income, which impacts many stocks, which especially will hurt consumer discretionary names. You think of stocks that are in that space, consumer discretionary. Treasury yields have spiked. The 10-year, when I wrote this, was over 2.62%. We've had an inverted yield curve, which happened. It kind of went away briefly, and then it kind of came back again today. So we're flirting on those levels for an inverted yield curve, which often is a indicator for a recession. That's usually 12 to 18 months later. But then you get job data and you get employment data, and we're at historic lows since like the 1960s with jobless claims and things like that. So it's really hard to interpret all this data and make sense of it as an investor. What do you do? Well, as a long-term investor, it's really easy because not much changes for my strategy. I'm not trying to get in and out of the market. The people that really stress out are the people that are trying to be traders or the people that just don't have the education to be long-term investors. They think that the only way to get rich is to move in and out of stocks and be some sort of genius. The easiest way to accumulate wealth long-term, guys, is do what I did. I came from nothing. I didn't know anything. Put 50 bucks a month into my Roth when I was able to get have a Roth, and just put that money away. And as I made more money, I saved more money. I learned more about the market, and it just grew. But the biggest thing is time, compounding. I just did a video on Warren Buffett. He's been investing so long, the majority of that money is just, he's performed well, but it's compounding, You make money on top of money. His Coca-Cola dividend, guys, his cost basis on Coca-Cola stock, KO, is like $3.52. Don't quote me. It's something like that. But his yield on cost is over 50%, meaning let's just say it's $3.50 as an example for his cost basis for the share. So each share of Coke he owns, he paid $3.50 for that share. He's getting over $1.50 a share in dividends annually, meaning his yield on cost, his dividend yield on cost, is literally over 50% of what his cost basis is for that stock. So he's made a crushing on the share price of the stock, as well as the dividend growth. And that's where dividend growth investing and compounding is really powerful. They've had shares of Coca-Cola for 60 years of compounding, and that's what can happen, and that's why it can be very powerful. So Russia, Ukraine, no progress. Supply chain continues to remain strained. We reduce things like wheat. We've got food crises. We've got all-time highs on food prices. We've got issues with shortage of fertilizer, which makes the problem even worse with food shortage because you need fertilizer to grow food. You've got neon gases for semiconductors, palladium. There's all kinds of supply chain disruptions because of this China-Ukraine war, and there's been no progress. So supply chains continue to have issues, and it's going to remain. Until we get alleviation of some of these issues, it's hard for the market to really go higher, and that's what we're facing. It's important to understand this, and maybe it'll make you feel more comfortable of why things are happening and what's going on around us. COVID, China has more COVID lockdowns. So the Tesla plant has been closed down, I think 11 days I saw something. All of these macroeconomic events, they're causing uncertainty, and many are worried about a possible recession in 2023. Like I said earlier, it's a possibility, but unemployment is 3.6%, historically low levels, some of the lowest levels we've seen since the 1960s, I think I saw this morning. And recessions generally have, they have high unemployment rates, which we don't have right now. The pandemic dumped everything upside down on its head. And stimulus, we had probably arguably too much stimulus that got pumped into the economy. And we've never seen anything like this before. We're in unprecedented times, and we can't really use history to compare this situation to anything that's happened before because it's never really happened exactly like this before. Now, I bought the lows heavily when you think of the March lows. For the most part, everything right now is higher than what I paid for it when we had those March lows. In my opinion, there are several opportunities that are acceptable dollar cost average ranges. So you think of this Upstart, 75 to 95. Etsy, I think 110 to 125. Roku between 100 and 125. I think those are good areas to dollar cost average. Could they always go lower than that? Sure. But I think those are decent ranges and decent floors, at least at this point, unless the whole market takes another leg lower. With that said, none are at the lowest point, it says right here. So in other words, like if you buy it today, it's not at the previous lows quite yet, but in this ranges, it'd be, kind of in those low ranges. My cash position is low, and I'm working on building that back up. I've spent a lot of money. I bought on the lows. I started buying probably too early, too fast, too hard, but I stayed committed to that, and I did my dollar cost averaging strategy. Overall, happy with what I bought. I could have been a little bit more patient. I certainly could have, but I don't beat myself up. I don't dwell on past, mistakes. I try to learn from that and go forward. And I've been doing this a long time. You're not gonna be perfect. Chalk it up as nobody's perfect and move on and try to figure out what you can do in the future. What can you do better moving forward? But don't worry about the past. You can't dwell on that. It's one of the top 15 investing rules for Fired Up Wealth. If the market takes a leg lower, I want to be prepared to add more. And so I want to build up that cash position. I like to have 5% cash at all times, and I'm not there because I've spent a lot of that cash. Now, I also need to pay taxes. Taxes are coming up next Friday, so I'm working with my CPA to kind of finalize what I owe. I got to pay some money in. I'm being completely transparent with you guys here. So that's why if you're in Discord and Patreon, you're not seeing as many buys as I was buying because I have less money, and the money I do have, I'm trying to sit on it. And I'm being a disciplined investor saying, hey, I don't want to spend money that I can't afford to lose. I don't want to put money in and then find out I owe, that money for taxes. So there's a chance that some of the money I have kind of sitting in cash right now might have to be used for taxes. Hopefully not, but I just want to be conservative in case. So that's what I'm doing right now. So because of these reasons, I'm not buying a ton right now high, and I wanted to explain why, and I just did. Remember, many of my holdings I've had for many years at much lower prices. The stocks that I'm buying, most of them are going to be newer IPOs that weren't publicly traded before, which arguably a lot of them were too expensive. The new 10, if you haven't seen that video, if you subscribe to Patreon for Elite or Platinum, you get a complimentary copy of the new 10 that you can watch, that you can review. Or if you don't want to do that, you can go on Gumroad and you can rent the video and you can just watch it one time and not deal with Patreon or Discord at all if that's what you choose to do. I'm still accumulating these new 10 shares. So an example of a new 10 stock would be like a Palantir. I'm still accumulating shares of Palantir. I bought Palantir at $9. I bought a little bit more at 20. And right now my cost basis, I'm actually, the last time I looked at my portfolio, I was green. Now after the last couple of days, I'm probably slightly red, but doing pretty good on the cost basis, still accumulating shares. I have high conviction in everything I own. I went from over 100 different positions. I'm down to about 80, and everything I have has a place in the portfolio. There are some that are on the chopping block that if I needed to get cash quickly, they would kind of go away first. But for the most part, I've eliminated names that I thought were highest risk or that I didn't think had as much upside from here. And if you're in Discord, you saw all those sells over the last couple of months, and you can go check those out. So if you're trying to build wealth, you should look at this year, 2022, as an opportunity to accumulate shares. And I know that can be difficult from a psychological perspective. That's why in the masterclass, which again, if you want to check out the masterclass, that you can get through Patreon on the Platinum. And so if you go join Platinum right now on Patreon, you're going to get a 30-minute one-on-one session with me, as well as full access to 11.5 hours of my best content, premium content, masterclass investing from A to Z. It's 12 classes. It teaches you everything from options to, how to do due diligence, psychology, everything that you need to know to be a long-term investor. If you don't want to do that, you can also go on Gumroad and you can just rent it and you can watch those 11.5 hour video this weekend or whatever and binge watch it and try to learn. It's everything that I learned over 20 years investing and trying to put it in 12 hours saying, if I'm teaching my 20-year-old self what not to do and how to do it correctly, here's what I would have taught myself. That's what it is, and you have access to that. And some of those videos are even on YouTube as samples. You can go check out the channel if you'd like and see what's out there. So if you have conviction, okay, so this is an opportunity to accumulate your favorite names over this year. If you have done your homework, this is why it's so important to do your own homework, have your own conviction. Because if you don't do homework and you just watch one of my videos or somebody else's, we're not financial advisors, and you go buy the stock, but you don't really know what it does, the stock goes down and you panic because you're like, why did I buy this stock? It's, it lost 50% of its value over the last couple of months. If you understand the company and you have conviction about the company and you're excited about the future of the company, you're going to sleep better at night knowing that, yeah, that stock is down, but I'm not worried about it because it's going to be fine, over the long term. And I've committed to be a long-term investor on this specific holding, right? So you can accumulate those favorite names at levels here or maybe even lower. You might get opportunity lower. So if you're working, you should be getting cash every paycheck, putting some of that to work. Try to save some cash just in case. And I know that's tough. Stocks might go higher and you miss the bottom prices, or they go lower and you don't have enough cash. You're not going to be perfect. Don't try to be perfect. You don't have to be perfect to be a good investor and to outperform the market. Peter Lynch proved that to us over and over again. He said that you only had to be right 6 out of 10 times and that you were doing pretty good. And if you're investing in growth stocks and if you're right 6 out of 10 times, you're probably outperforming, the overall indexes and the overall market. So, and you can outperform the market. A lot of people say, I can't, I'm just going to buy index funds. There's nothing wrong with index funds. I actually use ETFs as part of my core when I teach how to build a portfolio. When I build portfolios, this is taught in the masterclass. It's like a blueprint to a house. Why do I own these specific things? And what's my foundation? My foundation are ETFs and dividend blue chip stocks, and I'm building growth around that, trying to use growth to outperform that core. That's what it's all about with the spec and growth buckets. So definitely, check that out if that's interesting. If that's of interest to you, check out those videos. I think they'll be helpful. The big money is always made when everybody's running away. When there's blood in the streets, that's when you usually have opportunity. And I think that there are some opportunities here, even though we could go lower. You just dollar cost average, do your best. Every time you get a paycheck, you put a little bit of money in. And and you do your best and know you're not gonna be perfect and just think longer term. That's what it's all about. Will some of the stock picks that we choose be wrong? Absolutely. Just mentioned it earlier. But like I just said, Peter Lynch, 6 out of 10. It's all you need to be successful. And I think that I could do, 7 out of 8. Maybe it's the overconfidence effect speaking, but even if I get 6 out of 10, I'm doing well. I'm outperforming the market. Not only that, I own stocks of companies that I believe in. When you own a stock, you own a piece of a business. And I own stocks that I believe in the company, in the leadership, and I want these companies to do well. So I'm remaining patient. I'm remaining disciplined. And I'm highly confident in the future of what I own. I have high conviction in everything I own. And I think best of breed will keep winning over time. And that's what I sent out to the team and said, hey, this is what I'm thinking right now, guys. These are my thoughts. Real talk. I wrote it out. Now I just went through it and gave you some commentary on it. So if you're not a subscriber, please subscribe. Click that bell to get notifications. If this was helpful, if this helped you, you can help return the favor by dropping a like and dropping a comment. And do me a favor, in the description below, there's a link, and there's a link to Linktree. It has all the different platforms. Go check out TikTok. Go check out, everything that we have on there. Twitter, Instagram, Facebook. I'm really trying to grow those other platforms. And check out the different services. Try to check out the private community. Join us. You can join Discord for a month, Patreon Discord. If it's not for you, you cancel anytime. So love to have you guys. I've tried to teach long-term investing. I'm trying to build a community of like-minded long-term investors that want to succeed over time, that have similar interests, that are trying to achieve financial independence and financial freedom. So our community is much more than just stock picking. It's about all the things that we talked about today, even much more than that. We talked about student loans last night. We talk about retirement. We talk about, Roth IRAs, HSAs. We talk about international. We have over 35 countries represented. Talk about how international stocks work and different international ETFs and how it works in different countries. We've got a huge Singapore following, Canada, all over the place. New Zealand, we've got Australia, we've got all over Europe, South America. Anybody that I forgot, I apologize. We got a ton from Portugal, but we have a big international presence in there. It's an international trading community. That Discord community, there's people on there 24/7, any time of day. There's always somebody online and active because of all the different time zones we have represented. So check us out, guys. I hope this video is helpful. Have a great rest of your day. Take care.